Good morning everyone and welcome back to my channel. My name's Sarah Irons. If you are new here, I'm so happy to meet you. On my channel you will see mainly mortgage tips and information. That's what the channel was set up for. I am a commercial and mortgage property broker and I wanted to give everybody some insight into mortgages, what can and can't be done, overviews of the market, some tips on property purchasing, etc. I have owned 16 buy-to-lets in my time, so I have been a landlady of quite a large portfolio. I've done a mixture of holding and renting, buying and refurbing, and I'm about to embark on a development as well, so I will be talking to you all about that later on in the year, and you can follow that journey as well. I do try and add in some other videos as well. I am a mum of one, a 4-year-old Nola Blue, who keeps me busy, and I try and jazz it up a bit and do some interior hauls, fashion hauls, and just sort of general lifestyle. So if you are interested in either side of my channel, then please keep watching and subscribe to support my channel. That would be amazing. Thank you. I am a newbie, so forgive me for anything that is frustrating, like lighting and all sorts of things. I'm learning as I go. But anyway, the main reason for this channel is to give you information and tips and guidance. So if I can help you onto the property ladder, or prepare you for your mortgage advisor meeting, or teach you something you just didn't know, or give you some confidence to go out and do it, then amazing. That's what this channel is for. So today I am coming to you in this awful COVID-19 times that we find ourselves in. I'm giving you a market overview, let you know where we're at the moment, a bit of background, a bit more technical into the banks and how they're operating and finding everything, an overview on the market now and where I think it's going to go, and yeah, just a little chat and a little update. So if that video is for you, grab a cup of tea, maybe a bicky, and sit back, relax, and let's have a chat. So yeah, wow, I mean, this world we're in at the moment is horrendous. It's just unbelievable, isn't it? I actually can't believe it. It feels like we're in a movie, but we are where we are. And I think the reality of this nightmare is now fully settled on everyone's shoulders. So for myself, I predominantly work from home anyway. I do have an office at home, and my daughter's at nursery most of the week. But so working from home isn't actually new to me, but working upstairs where I have moved my office to, as you can see, I have a little spot up in my hallway upstairs while Nola is not at nursery. She is being looked after by my amazing husband, who has been amazingly supportive and enabled me to carry on working, and he's been holding the fort downstairs. So most of the time she stays down there, and I do get some time to work up here, which has been amazing. But yeah, I think, you know, the main stages, I mean, initially everyone was just in disbelief and shock about this nightmare, and I think everyone then was sort of adjusting to working from home. The next thing was, you know, how are we actually going to trade? For a mortgage broker, initially I thought it wouldn't affect us. The rates were lower, people would want the better rates. I thought we'd actually get busier, and in some ways we have. So product transfers are busy, life insurance is obviously busy. There's never been a better time to think about the protection your family has and needs. So yeah, there have been some benefits, because it's great to make sure you have got the right cover. You know, are you protected if you die? Would your mortgage be paid? Would your surviving spouse have enough money coming in to look after the children, etc., etc.? But that's another topic. I'm not going to go on about insurance today. But yeah, there are areas that definitely have become busier. So I'm thankful that the providers are still able to work, even though most of them are working from home, and the lenders continue to try to work. Having said that, I was shocked that a lot of lenders have just closed the doors, put a halt on the lending, reduced loan to values, reduced affordability, stopped taking bonus and commission, etc. And the biggest thing of all is the valuers. So no valuers were able to go out to a property anymore. Obviously, you can't see people or go into somebody's home, it would be foolish. So unless a desktop valuation could happen, which is basically the lender assessing the value on HPI, Halifax Price Index, which is like a national valuation grid of across the whole of the UK with percentages of price rises and falls as the economy goes on day to day. So yeah, apart from a desktop valuation, all valuations came grinding to a halt. So any mortgages that were past a valuation or post valuation and on their way to an offer pretty much made it through, and solicitors could still do their work, and a lot of them did make it through to completion. Any mortgages that were pre-offer weren't so lucky, or pre-valuation I should say, have either been cancelled completely from the lender system, which is, you know, really traumatic for the clients in particular, for the people trying to sell their houses, for the brokers, everybody really. So that was sort of really disappointing news, and we didn't really expect some of the lenders to just cancel applications from the system. So that is quite worrying. I would like to think at the end those can be reapplied for, re-picked up, and we can move on, albeit maybe with a slightly higher priced product. But yeah, that was quite shocking, and every day I was noticing a new lender withdrawing from the market. So yeah, the first week of isolation, that was quite a frightening week, and a real eye-opener that actually everybody's at risk here, and everybody's suffering because of it. So yeah, that wasn't great at all. You know, we just focused on completing the work that we had, submitting the deals that we had, while the lenders were open for business, you know, in a rush really, in case they closed the next day, just trying to get them in as much as we could, and also so that we could record accurately the cases that we did lose, and you know, when we're looking at our key performance indicators, you know, we had a true picture of the ones that were lost and the ones that got to pre-offer and post-offer and etc. So yeah, it was important that we rushed to get all of our applications in the best we could. And obviously lastly will be the recovery. So, you know, how will we recover? What's the market going to look like? So we sort of look ahead positively to when this is going to be over and life will resume, which it will. So an overview from the banking point of view. So there's two types of sort of funding lines, the banks and the non-banks, and obviously each category has sort of various different parts to it, but just keeping this really simple. So the banks have quite a few positives. They've got funding pumped into them via the Bank of England. They've stopped providing dividends, which means they're saving some money, whereas they're obviously losing some money on the people that are taking some mortgage holidays. So the two are sort of offsetting each other. They've obviously got liquidity schemes and recovery schemes in place, and they're sort of being looked after by the government. The negatives are, being such a big organisation, they do struggle with the infrastructure of working from home. So I think that's been one of the hardest things for the banks to sort of cope with in these times. Then you've got your non-banks, so more of your bridging companies, your private investors, or the companies that are more flexible, maybe with sort of a higher level of interest, but they are more quirky lenders that aren't backed by the government. So they aren't a bank, they're deemed a non-bank, not regulated in the same way as a bank, and don't have the same support as the banks from the government. So the good things about the non-banks is they charge a higher interest rate, so their income's going to be better at the moment from the banks, and also the bridging lenders tend to take all their interest up front, so they deduct it from the loan, which means they've already been paid their interest, so that is another benefit for them. They're also more modern companies, so the infrastructure of working from home, it's much easier for them to implement that, so I don't think they're struggling there. And most of them are still lending. Again, they are a bit more flexible in what they do. However, they have a lot more negatives than the bank. So these non-banks rely on something called securitization, which I'm not going to go into now, but at the moment the securitization markets are closed. So it is a big risk for them to keep lending, hoping that the securitization markets are going to open again in the future. I'm sure they will. However, desktop valuations, which means obviously that a transaction can continue to happen, it isn't stopped because a valuer can't go in. So they'll do a desktop valuation, which basically is an HPI check. They check online any comparables, check that they can be pretty happy with the level of value that this property is suggested at, and they are happy to sort of offer based on that desktop valuation. But securitization companies don't like them. You actually get fined if you have a desktop valuation, so that doesn't help the bank's bottom line either. And it's also a big risk that if they're going to do a lot of desktop valuations, will they get that securitization? And they do need that in order to continue to lend. So, you know, they've got a bit of a problem there. Also, they have higher costs of funding because they're a riskier lender and they therefore pass that. Also, you know, some people don't have the interest taken up front or have a roll up, which is interest taken up front. They do actually service the debt, and you know, 30% of people that are servicing the debt are taking their payment holidays at the moment. So, you know, they do suffer on the bottom line as well because of that. So yeah, two different types of lending, but equally both of them have their positives and negatives at this time. So what's going to happen to the housing market? We all want to know that. We all think it's going to drop. It actually has dropped already. Will it continue to do so? Probably. Nobody knows exactly the amount, and you know, what happens to the market depends on what happens to the economy. And the drivers for that are confidence, market confidence, unemployment, GDP, for example. However, we know that the market's already dropped. Obviously, a lot of sales have fallen through. People can't move forward to completion because of the value, as everything I've said earlier in this video. So can we compare it to the crash of 2008? No, we can't. That was because of high gearing, so high loan to values, and there's been many regulations that have come in, MMR, PRA are two that come to mind straight away, which have negated any sort of higher loan to value issues that were causing the market to run away with itself. So no, we can't compare it to 2008. We can just purely compare it to the fact that we cannot move forward to completion of mortgages. So the demand has dropped because it's had to, and the upshot of that is, you know, the confidence, the economy, etc. will also drop, and therefore the market will reduce. So maybe 20-30%, nobody knows the exact amount, but it will reduce. After Brexit vote, the mortgage market and the property market were really on a bounce. We hadn't had it so good in the mortgage market for many years. You know, we were noticing higher loan to values, interest only higher loan to values, affordability relaxing, extra income being taken into affordability, more desktop valuations at lower loan to values, higher lending calculations when it comes to affordability. And really the market was doing well. Prices were jumping up, and yeah, we were really seeing a bounce after that vote for Brexit. And then obviously this happened, and everything completely crashed down again, and the opposite happened. Lenders stopped lending, affordability reduced, they now aren't taking bonus and commission so much, no desktop valuations were being done, no valuations were being done, lenders dropping loan to values, getting rid of interest only. Everything that they'd come, you know, so good at was now being all retracted. So it was such a shame to see that in the market, and I'm sure it will come back. I'm not sure how long it will take to come back, but yeah, it was a shame. Mortgage holidays. So everybody has seen that you are able to, most of the time, apply for a mortgage holiday or payment holiday or payment break. Everybody can apply for this. Most people will be successful with that. And what it means is every bank now has to allow somebody to have a 3-month holiday break on paying your mortgage if you are suffering the effects of COVID-19 financially. Please do not just cancel your direct debit. You do have to go through a process with the lender. It's not a given that this is just going to be acceptable for everybody. So please don't just cancel your direct debit, because then it will be marked down on your credit history as a missed payment. So don't do that. Ask your lender. It's a very quick, easy process. Most of it's just a quick 5 questions online. And then they will let you know in a couple of days whether you've been successful and when to expect your payment holiday and when to expect your payments to start again. So it really isn't painful to do it the right way. Please do not cancel your direct debit and not ask the lender just thinking it's your right to not pay it for 3 months, because this will be deemed as a missed mortgage payment, and this will majorly affect you when you try and get any onward mortgages or finance in the future. Be careful, don't rush in to a holiday payment. Make sure it is right for you. It's not just 3 months off. You will pay a higher monthly payment after 3 months. They will add interest on, and you know, it's not just 3 months of free money. And also, we don't know, as much as it doesn't affect your credit score, we don't know yet the impact that it might have on further borrowing in the future. You know, will they look at this badly in the future if you have taken the holiday break? We don't know. So please only take it if you are financially worried about COVID-19 and if it is having an impact on you paying your financial bills. So if you don't need to take it, don't take it, but it's there if you need to take it. That's what it's designed for. And also, anybody, I did another video purely on this, but it is, you know, something I just want to say again. Anybody that's coming to the end of their fixed rate can apply for something called a product switch or a product transfer, where no underwriting is done. Now, I'm not saying this is right for you. Speak to a broker to find out if it is. A lot of the time it is right. If you don't want to change anything about your mortgage, you don't want any extra capital, you don't want to change the term, you don't have to worry about underwriting. So there's no income proof, no valuation, no legals, there's no underwriting. You literally just switch to a better product. If it's a better product for you, speak to a broker. My point is, if you are about to come to the end of your fixed product and you take a payment holiday, you will not be able to switch to a new product. You will go onto the variable rate and you will have 3 months at that higher variable rate of interest. So be careful. Now, if you're approaching the end of your product, you can actually move to a better product 3 months before your deal comes to an end. Not with every lender, so again, speak to your broker, but with the majority of lenders you can do that. So, you know, if you're thinking, well, I want to make my holiday payment now, but I'm still 3 or 4 months away from the end of my fixed rate, what am I going to do? You can change it now, and then you can apply for your holiday break if that's right for you. But if you rush in to get your holiday break, you won't be able to change to the cheaper rate. So that's something to really bear in mind. Have a look at your mortgage paperwork and just see, when does my deal come to an end? What am I going to be paying when it does come to an end? Just prepare for it a bit. You know, make the most of the time at home and go through the paperwork and you know, just really get to, what have I got? What rate have I got? What's the monthly payment? When does it come to an end? How far before can I change? Can I get a better rate? Can I get a better rate now? Speak to a broker and see what's right for you. Okay, so the market after COVID-19. We all want to know this. We all want a crystal ball. We don't have one, none of us know. However, my personal opinion is the market has dropped already. It will drop further. How much, I don't know. 20%, 25%, maybe 30% for a short period of time. Personally, I think it will drop by. Demand for buy-to-let is high. As a lender, from a bank's point of view, 3-month arrears history on a buy-to-let is half of what a residential is. All the legislation that's come in last year, PRA in particular, is now means that you can't really get too much of a high loan. So low loan to values and low loans on most buy-to-let, so low risk for a lender. why wouldn't you lend from a lender's point of view? The rentals are going to stay the same. So from a investor's point of view, you've got a market that's dropped and will go up again. You've got rents that have stayed the same, so therefore your yield has now grown bigger. So from an investment point of view, I think there'll be a lot of investors that want to come back out and make use of this. I think we're going to see more repossessions where unfortunately people have lost jobs and maybe haven't been able to keep up their mortgage repayments, and they will be repossessed after that mortgage holiday stops, potentially. Again, we don't know whether that mortgage holiday will be extended, but you know, there will be people that do fall foul of this awful situation, and it is awful, it's horrible. But the upshot is, from an investor's point of view, there will be more properties going into auction, more properties being sold via estates from elderly that now either don't want the property or have deceased, unfortunately. So there will be more auction properties and lower priced properties coming onto the market. Also, there's a lot of sales that have fallen through because of this. They will be dropping the price if they're in a position where they do need to move on. So there is going to be an influx of properties to the market at a lower price than they are now. You know, investors are going to want to make the most of that opportunity. As I just said, first-time buyers, I think they'll also benefit because the market will now be more affordable for them. So I think we'll see a lot more first-time buyers coming out. We do still have the Help to Buy, not for too much longer, but it is still available at the moment. I think movers will benefit because now they'll be able to buy maybe a bigger property than they could before, because their money is going to go further. So the deposit they had will now buy a larger property than potentially they could have bought before, because the market's dropped. So I think market-wise, there are going to be, everybody's going to benefit in some way. Maybe not everybody, obviously, if you don't have an income because you've lost your position. Yeah, I think some people will benefit. Not everybody, some people will benefit. And I think, you know, for a short period of time, there is going to be a time where investors can sort of step in and get some properties. And the market will recover and they can potentially make some money there. So yeah, I do think that we will see a recovery quite quickly, a bounce quite quickly, and potential illusion that, you know, we really are, the market's really recovered, because obviously people will be playing catch up. All the people that are in the transaction at the moment are on hold, they'll be playing catch up, plus we'll see the new investors, the new first time buyers back into the market that weren't there before. On the negative, we will still have the additional stamp duty, and we do have the tax changes on rental income, and they were the drivers that were slowing down the buy-to-let market before. So it will be interesting to see whether the drop in the market value will be enough for the investors to come back, or whether the stamp duty and the tax changes is enough to keep them investing in other things. So yeah, I'm sort of interested to see how that develops. That's my overview. Hopefully you got some bits out of that, or some comfort from what I think might happen in the market, and a bit of an insight into what the lenders are doing at the moment or not doing, and where we are with things. The lenders are constantly working towards finding ways to move forward. Desktop valuations is the thing at the moment that everybody sort of, or a broker is looking for. So lenders that are doing desktops means the transaction can continue forward to a point of completion, which is where everyone wants to get to. So keep your eye on my videos at the moment. I will keep updating you. As we get updated, I will update you. I'm watching a lot of webinars myself. I've got a lot of information on what I said today from information that I have learnt from listening to other people more in the know than I am. So I thank them for that. And obviously, if I can help you at all by sharing some of my knowledge with you, great. If you learned something brilliant. If you haven't, I'm sorry. Hopefully my next video will be something that you can glean something from. And if there's anything you want me to share with you, any knowledge that you do want to hear, let me know. Please leave questions below. Give me topics that you'd like me to speak about. I'd love to be giving you the information that you actually want to hear. You know, this channel is for you. I want to help you to learn and prepare better, so that, you know, you can prosper. So yeah, please do give me some hints on things that you want to hear and learn about, and I'd be more than happy to do some videos on them for you. So, you know, the only thing I will say at the end of this video is, do we really need mortgages to buy and invest in property? Obviously, I'm sort of slightly putting my investor head on now. You know, there are some other ways that you can purchase an asset without the normal mortgages. And this other way I'm going to do a whole video on, so it's more property tips and investor tips, maybe not buying in the traditional way. And again, I don't think there's ever been a more of a market where this could really work for somebody. So I'm going to give you some insight into some more less formal, sort of more creative purchase methods in my next video, where you won't get the stamp duty or the tax implications, but you can control an asset without necessarily owning it in the traditional way. So yeah, if you're interested in that, then look out for my next video, which will be a sort of property tip rather than mortgage tips. So thanks for watching. Hopefully I haven't rambled on for too long. And yeah, any questions, please leave them below. If you are working from home, I hope you have a really fantastic day, and I am now going to continue on with my applications, and I hope you have a brilliant day. Thanks for watching. Bye.